Welcome to this explainer. Listen, for years, the startup world had one really loud, dominant narrative, right? Raise millions of dollars, hire these massive teams, and just burn through cash to capture the market. But right now, we're seeing a massive David versus Goliath shift happening in the SaaS space. A quiet revolution is completely taking over. Solo founders and bootstrap startups are literally rewriting the rules of software entrepreneurship. They're leveraging brand new tech and extreme capital efficiency to win, and they're winning big. So, today we're going to unpack exactly how they're doing it, the specific metrics you actually need to hit, and the playbook you can use to do it yourself.
So let's jump right into it with a pretty provocative question. Is the traditional venture capital SaaS model dead? I mean, for the last decade, the conventional wisdom was just grow at all costs. You raise a massive seed round, spend aggressively on ads, and, worry about profits way down the line. But the market has fundamentally shifted. That old high-burn playbook, it's broken. And the data we have for 2026 proves exactly why.
Just take a look at this shocking stat. $2. That is the median amount a SaaS company now has to spend just to acquire $1 single of new annual recurring revenue. That's up 14% since just 2023. Digital advertising costs are climbing, buying committees are getting larger, and sales cycles are just dragging on longer. The math of buying growth with expensive equity simply doesn't work the way it used to.
Which brings us to part 1, the VC growth myth.
We've all been conditioned to believe that heavily funded companies absolutely crush bootstrapped ones when it comes to growth, right? But when you actually look under the hood, the gap between the two is shockingly narrow. Look at this survey data from 2025. VC-backed SaaS companies grew at a median of 25% annually, and the bootstrapped companies, they hit 23%. I mean, that difference is practically negligible. Those massive piles of venture cash are only buying a tiny incremental bump in median growth. The real difference isn't the growth rate at all, it's how much cash they're burning to get there.
And this bootstrap advantage becomes incredibly clear when we look at companies hitting that $1 to $3 million ARR mark. Bootstrap teams are generating $110,000 in revenue per employee. Meanwhile, equity-backed companies, they're only hitting $94,000. Why? Well, because bootstrappers are forced to be highly capital efficient from day one. They don't have a massive safety net, so their unit economics have to be superior right out of the gate.
All right, let's move into part 2, achieving ramen profitability. So you might be wondering, how are these incredibly efficient small teams surviving those crucial, scary early days? It all comes down to hitting ramen profitability. Let's quickly demystify this term. Ramen profitability happens when your startup generates just enough revenue to cover your basic business expenses plus your personal living expenses. Now, obviously, it's not about literally eating cheap instant noodles every single day. It's about reaching this ultimate point of leverage. When you hit this milestone, you are no longer racing against a ticking clock of a dying bank account. You finally have independence, and most importantly, you don't have to dilute your ownership just to survive.
Andrew Rasmussen, the co-founder of the customer feedback app Canny, actually sums this up perfectly. He and his co-founder hit ramen profitability in just 7 months. How they do it? By working as digital nomads. Like he says, you build a solid foundation and you retain more ownership. By working anywhere with Wi-Fi and keeping costs incredibly low, they built a highly profitable base and kept all their equity. It's a real game changer.
Okay, part 3, the capital efficiency scoreboard. These are the metrics separating the winners from the losers in 2026. Because once you survive that ramen phase, how do you actually scale efficiently? Well, the primary diagnostic tool that founders and modern investors are heavily relying on right now is the burn multiple. It's pretty simple. It's your net cash burned divided by your net new ARR. Think about it. If you burn $3 million to make $1 million, your multiple is 3. And in today's market, that is a massive red flag. The target you want to aim for is less than 1.0x. If you're past the seed stage and your burn multiple is high, listen, you don't have a growth problem, you have a capital efficiency problem.
So, hitting the right benchmarks across the board is absolutely crucial. For 2026, here's what you need to target. You want your net revenue retention hitting 106% or higher. You need gross margins above 75%, and that's vital because that high margin is exactly what lets you reinvest in your own growth without begging for outside capital. And finally, your customer acquisition cost payback needs to be under 15 months. Let's break these down real quick, starting with the big one.
Think of it this way. If ARR is your startup's heartbeat, net revenue retention, or NRR, is your cardiovascular fitness.
When your NRR is above 100%, it means your existing customer base is actually spending more with you over time, which completely offsets any customers you might lose. Companies with NRR above 100% are growing 1.5 to 3 times faster than their peers. It is literally the closest thing to SaaS nirvana.
But before you can even think about expanding revenue, you have to stop the bleeding. 3.5%. That was the average B2B SaaS monthly churn rate in 2025. Churn is the silent killer of recurring revenue. I mean, if you're losing customers faster than you can bring them in, expansion revenue is basically just putting a Band-Aid on a gunshot wound. The absolute best-in-class target. You got to keep that monthly churn under 1%. And then there's the speed at which you make your money back. Best-in-class SaaS companies recover their customer acquisition costs in under 12 months. This speed is critical for survival. Companies with a CAC payback under 12 months are the ones that actually survive economic downturns. It means the cash you spend today comes right back to you within a year, completely ready to be deployed again.
Which leads us to part 4, vibe coding and micro SaaS. So now that we know the strict financial rules of the game, how are these tiny teams actually building the software to hit these targets? Imagine typing this: create a simple e-commerce site with a minimalist vibe. By just typing a natural language prompt like that into an AI, founders are generating functional code in minutes. This is called vibe coding, using AI tools to build software without needing a massive team of expensive developers. It sounds like pure science fiction, but honestly, by 2026, 84% of developers are already utilizing these AI tools to overcome the blank page problem.
So here is the exact 2026 playbook that solo founders are running to achieve profitability in just 12 to 18 months. Step 1. Find a highly specific, unserved niche pain point with a clear money flow. Step 2. Use vibe coding to build a minimum viable product in days, not months, keeping your development costs basically near zero. Step 3. Run a micro SaaS. You don't need to conquer the entire world. You just need to generate $5,000 to $50,000 a month in a niche that the big enterprise tech companies are completely ignoring.
The advantages of doing it this way are just staggering. It entirely eliminates expensive dev costs. It gives you 3 to 5 times faster prototyping. You can have one AI agent orchestrating the UI, while another handles your entire back end. This incredible leverage is lowering the barrier to entry so drastically that experts are projecting a massive boom of 25 to 30 million solopreneurs in the US alone.
All right, let's look at part 5, the new funding playbook.
So what happens when a bootstrap team finally does need capital to scale from, say, 1 million to 10 million in revenue? Well, they certainly aren't going to standard venture capitalists anymore. Venture debt reached a staggering $68.8 billion in 2025. Why? Because founders absolutely refuse to give up cheap equity. With equity valuations under so much pressure, we're seeing this massive shift toward non-dilutive revenue-based financing. Founders want the capital to fund specific growth initiatives, for sure, but they want to protect their hard-earned ownership at all costs.
But to actually secure this non-dilutive capital, meaning a lender writes a check without taking a board seat, they look for very specific health metrics. You're going to need a minimum of $10,000 in monthly recurring revenue. They want to see a consistent 5 to 15% month-over-month growth. They'll require that NRR to be over 100%, and gross monthly churn needs to be below 3%. If you build your micro SaaS correctly, you can unlock millions in funding without ever selling a piece of your company.
Just a quick word of caution as you scale, though. Premature scaling kills, literally. Only 1 in 10 startups that hit the 1 million ARR mark will ever reach 10 million. It takes an average of 2 to 5 years just to hit that first million from your initial monetization. The absolute best companies out there understand that going slow to go fast is the proven path. You have to perfect those unit economics before you ever step on the gas.
So let's summarize the core thesis of everything we've looked at today. Capital efficiency and AI leverage have completely rewritten the rules of software entrepreneurship. The 2026 winner does 3 things. First, they validate fast by talking directly to paying customers. Second, they build small by utilizing vibe coding for narrow niches. And third, they retain total ownership by utilizing revenue and non-dilutive debt to scale up.
Look, the tools to build a highly profitable, scalable software business have never been more accessible, and the cost of entry has literally never been lower. You don't need a massive team, and you sure don't need VC permission to build an empire. So I'm going to leave you with this question. What specific micro SaaS niche are you going to conquer today? Get out there, find the pain, and start building. Thank you so much for joining me on this explainer, and I'll catch you in the next one.